Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, I'm going to demystify the stock market. Okay, let's dive in. Investing in the stock market can seem like a crazy prospect for a generation of millennials and Gen Zs that are dead broke with only 2 cents in their pocket and a $100,000 student loan for a degree they don't use. But here's the kicker. When it is done right, you can take the 2 cents and turn it into 3 cents, and well, that's more than you had yesterday. Isn't that the goal? In all seriousness, the stock market is often perceived as a big scary abyss of money that eats investors alive and is the path to infinite riches for those who understand it. While those perceptions can be true, understanding the stock market and succeeding in it, in making money with it, is far much easier than you think. What is a stock? In order to understand the stock market, first, we need to understand what a stock is. A stock, also known as a share, is a financial token or instrument that signifies ownership in a company in some proportion. For example, if Google has 1,000 shares and you buy 1 share, you would own 1/1000th of Google. In reality though, Google and companies and similar companies have millions of shares. When you own a stock, that means that you own a proportion of that company. As the value of that company increases, so does the price of your stocks. There are common stocks and preferred stocks. Common stocks are shares that entitle shareholders to dividends that vary in amount and may even be missed depending on the profitability of the company. Preferred stocks are shares that entitle the shareholders to a fixed dividend whose payment takes priority over that of common stock dividends. When companies make profits, they sometimes share their profits with their shareholders in form of dividends. Companies can share their profits or choose to reinvest back all or some of their profits back into their business. Common shares have voting rights and preferred shares don't have voting rights. Voting rights gives the shareholders the right to vote on important company matters such as board elections, mergers, and other financial decisions that are important to the shareholders. Okay, why do companies sell stocks? Companies sell stocks in order to raise capital. Companies can use the money raised by selling stocks to 1. Expand into different geographic locations. 2. Conduct research and development. 3. Hire new employees. 4. Purchase land, property, and equipment. Or 5. Even repay back old debt. Stocks allow companies to raise massive amounts of capital. The modern stock market often bases the value of a company on its potential earnings in the future. This means that small companies can earn millions or billions of dollars if investors think that the company can succeed in the future. Stock investing is based on the confidence of investors. What is the stock market? Companies list shares by selling them through an initial public offer. When companies conduct an initial public offer, it is the first time the company, as a private company, is offering to sell its shares to the general public. The founders of the company can choose to cash out their stake or simply let the company raise capital. Once a company's shares are listed on an exchange, such as the New York Stock Exchange, NASDAQ, or even the Nairobi Stock Exchange, the public can trade them. They can buy and sell shares on these secondary markets, called the exchanges, or the stock markets. Prices of the stocks will usually fluctuate based on public opinion, but the concrete fluctuations are based on the company's earnings or operations. This can be measured by the PE ratio or the price to earnings ratio. I have talked about the price to earnings ratio in my previous video. Kindly watch it to understand what the price to earnings ratio is. So in summary, when you own a stock, you own a portion of that company. You own a portion of their earnings and their profits. There are 2 types of stocks: common stocks and preferred stocks. Common stocks have voting rights. Preferred stocks don't have voting rights. Companies raise capital by selling shares. They can do this for several reasons: to expand, to conduct research, to hire new employees, to purchase land or property and equipment, or even to pay down debt. Okay guys, I hope you've enjoyed this video. Kindly like, subscribe, comment and share. I'd love to hear from you guys. See you in the next one.